Hey there, welcome to the Guaranteed Retirement Guys show. Today we're going to be talking about the safest types of annuities in today's market. So if you want to be safe and you're thinking, I like to keep my money safe and I'm looking for the best annuity, well, certainly variable annuities are not the answer. We will be talking about fixed annuities and fixed index annuities today. And I deal with these all the time. I sell hundreds of these and I have access to thousands. And if you're looking for the best annuity and you're looking for someone who's transparent, who will show you everything, then I would invite you to book a call. There's a link below this video. It goes directly to my calendar, or you can go to my website, johnstevenson.com, and you can look at all the annuity payouts. They're all there. And I have direct feeds to all the carriers. So if you want to take a look at my calculators, you can do that. And then, of course, you can book a call with me there if you like to. So I'd love to help you buy an annuity if that's what you're looking for. So anyways, but I want to share my screen because we're going to be looking at these together. And I want to show you the safest ways. And what as far as annuities, if you're looking for safety, fixed annuities are the best. Fixed index as well. Fixed annuities pay out a certain rate. They're like CDs. They never change. It's great. They're not tied to the stock market at all. They're tied to the interest rate environment. If interest rates are good, they're good. If interest rates aren't good, they're not as, obviously the payouts are lower. Fixed index annuities are a different animal. Okay. You have to make sure you choose the right one with the right company, with the right index. And unfortunately, a lot of guys just don't know what they're doing. Or they do, and they're just selling you the wrong product because the commissions are higher. That's a horrible way to do business. Okay. If you're looking for high payouts on those, you have to pick a reputable company that has good indexes like the S&P 500, okay, not some special BlackRock or Fidelity or some other index that looks good, or even some of the variations of the NASDAQ. You're thinking, oh, it's the NASDAQ. No, it's not. Okay, you have a lot of these variations that look good and they smell good, but I promise you, when you get into those and you buy those, you're always disappointed. Okay, so and when I deal with those, I'm only going to be recommending just a very select few that I'm comfortable actually recommending, because I want to make sure that if you see me in a year and we go out to lunch, you don't want to shoot me. So I want to make sure that you have a good experience with that. Okay. All right. So let's dive in. I'm going to show you exactly what's available. All right. So in this particular example, I am showing Lincoln. Okay. Lincoln is one of many carriers. Okay. I have access to over 70. Okay. The reason why I'm choosing Lincoln in this example is because I like their participation rates. They give you 55% of the index. Now, they can give you higher. You can see 82% and 75% if you were going to lock it in for like, if you were going to measure the index for a 10-year period, they'll give you 82%. If you're going to measure the index for a 5-year period, they'll give you 75%. But it's point to point. Okay. There are no resets, okay, annual resets where you get them interest credited and you get more money in there that's compounding. So typically when I recommend, I'll always tell people to do a 1 year. Okay. A lot of advisors will show you a 2 and a 3 and a 5. I don't usually recommend that. I like to have more interest compounded more frequently. Okay. But that's totally up to you. And the reason also why I'm looking at Lincoln is because Lincoln has a reputation with the S&P 500 to keep their participation rates at a decent level. Okay. They don't drop it like crazy like some of the other ones that I've seen drop. So it doesn't mean that they can't, but when I recommend companies, I am looking at companies that have a reputation of not. Okay. Delaware is another one. I do like them. They're a newer company, but they fight for your business more, and I like that too. Some people don't like that. They want an older company, and Lincoln is older. They're 120 years old. But I do like newer companies as well because they do fight for your business more. And they want to be on top more. They are hungry more. And so I do like that as well. So Delaware is a good company as well. National Life Group, Gillico are a couple others that I like as well. And they give you caps. So caps, if they're high enough, can be good. But a lot of times with those companies, they just don't outperform these participation rates. When you get a percentage of the index, you typically do a much better than just being capped. So let me show you what this looks like. So we'll look at the let's see, 55%. Let's see what that looks like here for growth. And of course, market protection. So $750,000, if it sits there, obviously it does nothing. If the market does nothing, it's not going to earn anything, but it's not going to lose anything either. Because again, you're protected from the market because they're buying call options with the S&P index. Okay. If the S&P does well, they're going to exercise those call options and they're going to make money, and so will you. When the market doesn't perform well, they're not going to exercise those call options and they lose the premium they spent on that. And so that's kind of the cost of protecting you, is they don't give you all of it when it does well. Okay. So in this case, they're giving you 55%. And you can see you're getting okay growth. I would say pretty decent growth. I mean, some of these are getting like 15, 16%. That's pretty good. Okay. I can live with that. If it's the ones that give me like 6 or 7% that I'm not happy with, and it's because they lower their par rate so much. So, or they're in the wrong index and you're getting 2% or 3%. It's just terrible. So you got to do it the right index. But you can see 750 does well. Oh, after 10 years, it's grown to like 1.63. It's not going to beat the stock market, but you weren't in the market and you were protected from any type of losses. So if the market drops through the floor, or if you have a bad recession, your account's just going to sit there and wait till the next upswing. Because you can see right here, it's worth $877,000 after 3 years projected. Okay. But then if there's a year where you don't earn anything, it's still 877. That's your new floor. Okay. So wouldn't it be nice to just do this and then up and then do this and then up instead of this and then this and then this? Okay. A lot of people don't like that. And so they want safety. This is the best way to do it, in my opinion. Okay. So now let's go to the fixed side. Very boring, fixed, but it's pretty good still because the rates are high right now. So if we look at those, we look at top MYGAs. MYGAs are multi-year guaranteed annuities, are fixed contracts. They're like CDs. Okay. So based off of that, we're going to go down. They go from like 2 to 10 years usually. There are some states where you get like a 15 or a 20-year option, but it's not common. So if we go up here, we'll say 10 years. So, and this is just showing the top 3. Some of them are with the same company. But if I just say the top 10-year option, just top one, 5.85. But let's say I want to be able to have access to the interest without any surrender charges. Then on 5.75, that's still not bad. So I'll take that and say, okay, what does that look like? Again, this is tied to interest rates. You're not in the stock market. They're not even buying options with this. Okay, this is tied to interest rates. It's backed by bonds. Okay, it's backed by safety. So when you're looking at this, you say, all right, well, if I let that thing sit there for 10 years, a guaranteed ending balance is 1.3 million. Okay, that's what it is. The last payment would be $71,000 because you've got like an account value of 1.2 earning that 5.75 if you let it compound. If you don't let it compound, then your earnings are like 43 grand a year, and a lot of people do that too. They'll live off the interest and then they'll get their 750 back at the end of it. So that's a great way to do it. It's boring, it's easy, there's no fees, and it's just, this is how it works. Very simple. People like to park their money and they like to get a good interest rate and they like to peel off the interest and they'll take the money and put it into something else later on. Now, if you're looking for lifetime income though, I highly advise against this, okay? I would highly advise against this because if your goal is lifetime income, you're going to do a lot better with a lifetime income rider, okay? You're going to get more guaranteed income. It's never going to go down. You're not going to be subject to interest rate fluctuations or anything like that. So just keep that in mind. If your sole goal is lifetime income later, don't park your money here and hope that your income is going to be higher later on from it because it won't be, okay? You can see 1.3 million, pretty darn good after 10 years, okay? But I can go here and I can show you. We can go to income. And I'll show you the same 10-year period. Okay, 1.3 million in a MYGA. Great, you got cash. Good for you. I mean, that's good, absolutely good. But if you're using it for income, you're going to turn around and turn it into income right after that. Probably not so good. Okay, and I'll show you why. Here's the income after 10 years, 1.9. Wow, pretty good. What's that based off of? Well, again, you put 750 in. If you left it in the MYGA, it grows to 1.3. Okay, look at this. Income rider grows it to 1.748, guaranteed. Okay. That's with no growth over here. They're assuming no growth in the index, nothing. 1.7 times 6.85. Now you tell me, would you like a 1.3 multiplied by 6.85 or would you like a 1.7, right? That's why I just tell people, if your sole goal is income, think before you buy. Make sure you buy the right contract for the right purpose, okay? And then they show you that if the index grows, yeah, it'll grow to 1 million, sure. But again, the guarantee that you bought is 1.748 times 6.85. That's what you want. That's what you want for the income. Otherwise, you're going to shoot yourself in the foot and you're going to lower your income by like 20% because you chose to do a MYGA. Now, MYGAs aren't bad, but they're for parking your money and not using it for lifetime income. You can use it to peel off interest or whatever and let it grow. But if your sole goal is more, just a huge pension, don't do it. So anyways, that's my opinion on that. I hope this has been helpful. I hope you like the transparency of these videos. I hope you go to the rest of my channel. You'll see a ton of videos that answer a lot of questions. If you're looking to purchase an annuity with me, I'd love to help you, okay? And I say with me because a lot of people will come and get this advice and they'll go back to their advisor. Please don't do that. If you are looking to purchase, I'd love to help you. I'd love to earn your business. And I hope that the transparency in these videos, I hope it lets you know that I'm showing you everything because I am. And when you go to the website, you'll be able to see all of the annuities that are available. And then if you want to book a call there, it's a Zoom call. We can get on a call there. Or otherwise, you can go to the link below this video and you can book a call with me there. But I try to be transparent. I really try to get as much education out there as possible so people can learn and make the best decision for themselves. And then if you are looking to purchase, I hope that you feel comfortable reaching out to me, because I'd love to help you. So anyways, I'm not going to try to hard sell you anything, but I do want you to see what's available. And of course, if it makes sense, I'd love to help you. So again, thanks for watching. I appreciate you. Make sure you like, subscribe, share, comment below if you got questions, and we'll see you next time.